Good morning, everyone. Please tell me if you see this guy walking around somewhere in the building, because I haven't seen him before. It's interesting that Benjamin actually mentioned it earlier, because I actually did have the opportunity to lift a cup once. It was just after we won the World Cup in 2007, actually, and I was flying down to Cape Town, and they actually said that they had the cup on board, and they took it out and they gave everyone a chance to actually take a photo with it. Which is quite amazing. Didn't bring the photo, but please believe me, it is true. Great. From my perspective, thank you very much for your time. I know it takes some time out of your diaries, busy diaries, but I do appreciate the time to actually spend with you and just to go through the portfolios themselves. I think we certainly had a difficult year. Feels like a little bit. Feels like I'm sort of talking about the same stuff every year. I remember standing pretty much in front of some of you 12 months ago, saying exactly the same thing, and it's been tough. I think it's been tough for me. It's been tough for the team. It's been tough for the industry, and it's certainly been tough for you, I'm sure. Sitting in front of clients, going through portfolios, going through returns, or the absence thereof, and it's difficult times. I think, as Herman probably mentioned earlier, certainly there are some. I think there's reason to be optimistic as well at the same time, but we also need to be realistic in terms of where we're at. So what I've done for today's presentation is aptly named Back to Basics. I only realized afterwards that there's actually an album, a Christina Aguilera album, which you believe that's also called Back to Basics. So it's completely unrelated. I'm certainly not as pretty, but the intent was really for me to just take you through the portfolios as we look at it. It's intended to give you a sense of what's happening, what's worked, what hasn't worked. And maybe as I finish up as well, we'll talk a little bit about what you can do going forward. Certainly from a portfolio management perspective, we tend to squeeze that lemon as hard as we can in order to extract some return, some alpha. But from an advisory perspective, I'm sure the dynamic is much more complex as well. So we'll go through it. Hopefully there's time for some questions afterwards. I know we enjoyed a nice little leg stretch. But bear with me, and we'll go through it quickly. So from an agenda perspective, as I mentioned, probably looks a little bit longer than it is. But in reality, or in essence, what I wanted to talk about is, first of all, just, again, how we go about things. So just setting that asset allocation, or that strategic asset allocation. Herman spoke about it as well in his presentation. But I just want to, again, reiterate the point, or almost give some context. Then we'll go through the portfolios, we'll look at that, we'll look at what worked, what didn't work, and then lastly we'll just finish off with a couple of, should I say, points to take home. So first of all, looking at it from an asset allocation perspective, I think these are numbers that you may or probably would have seen before. And I guess the big number behind me is the one in the red circle. It's at 70%. It's a 70% that says that historically, and I mean, there's a lot of research that was done about it in the past that says that, or indicates, or proves that as much as 70% of your return is really explained by your asset allocation. So what it means is that your decision to select a combination of equities, bonds, cash, offshore equities, bonds, and so forth, is the primary driver of your outcome. It's not about, yes, you can enhance that return, as we do, through a careful and meticulous strategy selection and mandate execution, but it's what you do with the asset allocation that's really going to be the most important thing in terms of your success. Now, as much as we spend as much time on it as anything else, and the reason is because you need to get this right, because if you don't, you're on the back foot. So again, I guess what we wanted to talk about today is, number one, the importance of a strategic asset allocation. Why we anchor to something. It's important for us to know that, similar as I'm sure a lot of you use Waze, which is an app on your phone that gives you a nice, should I say, a route to wherever you're going. That strategic asset allocation is pretty much our Waze. It's a thing that guides us towards our destination. Now, in a similar way that Waze or Google Maps, depending on your preference, would guide you along certain routes. Especially traveling here this morning, for those of you that didn't take the train. You're constantly having to adjust. You have to maneuver, and you have to compensate for things that you did not foresee. Now, those are the, should I say, the disciplines that we refer to typically as our dynamic asset allocation process. The dynamic asset allocation process, as you can see in the middle, is a little bit more medium term. It looks at a 3 to 5 year view. So we still anchor to the long-term strategic asset allocation, which Herman quite eloquently pointed out earlier, which is really much the 10-year long-term view. The dynamic allocation process is one that's a little bit shorter in nature. That's where we look at scenarios, what may play out in the next 3 years, how things will react given certain valuations. And I guess the one that we probably know most of, and then the one that we enjoy talking about, is the tactical asset allocation process. That's a shorter term part of the process. So here we talk about, as Herman said earlier, whether equities are more or better valued than property, whether we see shorter term risks in terms of recession. And that's where we, as portfolio managers, are able to implement various instruments, call it hedging, call it overlays, call it protection. Those are the kind of things that are at our disposal to manage this journey. Again, back to the Waze example. So if we look at it, that's a point of departure. But we also need to recognize that given that we have this anchor in these asset allocations, we often need to look at the market as a whole and say, well, given the market outcome, how did that transpire? How did that influence our portfolio positioning and our portfolio returns? So I think this slide is probably not news to anyone. If we look at how the market has really returned, or market returns over the last 12 months, and it feels like, again, a little bit of deja vu. It's a little bit of where we were last year. And the big thing, of course, has been that domestic growth asset classes continue to struggle a little bit over the last year. Yes, equities on a 12-month basis looks slightly better. I think it was up around 6% or so. But properties continue to struggle. And it continued to struggle for exactly the same reasons that Herman mentioned. Vacancies, lower escalations, all those kind of things weighed heavily on the sector. And it's very difficult, I guess, as a whole for the sector to shrug that negative sentiment, and we know sentiment does drive, so certainly drives return over the shorter term. What is interesting, of course, or notable, is that global assets performed quite well. And these returns behind me are all based in rands. So even though the rand weakened by 2% or so over the last year, all those asset classes did fairly well in their base currency. And I think most notably, and something you'll see over, whether you look at it over 12 months, 3 years, 5 years, is that investors weren't rewarded for risk. You weren't rewarded for taking on equity risk, and you certainly weren't rewarded for taking on the risk in terms of domestic properties. So if you look at it, just again over the last year, just to maybe put the returns into perspective, what I've graphed behind me is basically the real returns of each asset class over the last year. So you can see that from a real perspective, local equities returned, say, 1.9%. It's basically the 6% less the 4.5% of inflation. And by way of example, that means that equities, properties, and ILBs undershot what our long-term expectations are for those asset classes. Now remember, and I think it's also fair to say that returns don't come through in a straight line. If that was the case, I think I would have been out of work and it would have been a lot easier to stand here. But in reality, so we know that returns will come through in certain chunks. Sometimes it's big-sized chunks and sometimes not. But in reality, what we have had is exceptionally good returns from, as I mentioned, global asset classes and defensive asset classes. Those returns have actually overshot what our expectations would have been over the longer term. So again, that just makes our lives a lot more difficult, because if you look at it from a portfolio management perspective, in terms of us aiming for higher CPI-linked returns, again, it's been an incredibly difficult task. As I mentioned, over the last 3 and 5 years, it's unfortunately a bit of a copy-paste. And again, you can see behind me how the ASISA low equity category, the graph furthest to the right, has actually outperformed medium and high equity. So again, it's almost like an inverse of what you would traditionally expect from asset classes. Hence me getting quite excited when in the office when we debate asset class views and expectations that when we start talking about the expectations for equities and property over the next, say, 3 to 5 years being more optimistic, that's when I get excited, because that's what we need. And we did deliberate that quite extensively in the office as well, and that's why, from a portfolio management perspective, we rely quite heavily on Herman and his team in order for us to incorporate these views into the portfolios and for us to understand what risks we take associated with those asset classes. As you can see, as I mentioned just briefly, the 5-year picture, exactly the same. The big thing here, of course, is on the CPI-linked object, or from a CPI-linked perspective, you can see it doesn't matter which sector you look at, whether you look at high equity, medium equity, or low equity, all those categories basically struggle to get to CPI, CPI plus 1, CPI plus 2. So it's been tough, and I can fully appreciate that. If you look at it from a fund perspective, just putting that in context, over the last year we got some stuff right. Some of our decision-making, some of our positioning contributed to returns. And those I've mentioned in the chart or the table behind me. As you know, last year, of course, Regulation 28 was relaxed a little bit, the middle part of 2018. And we've taken the opportunity to increase our offshore allocation, for example. And that played out well, I mean, as you saw in the returns. So too, our tactical positioning. And I've mentioned two specifically here. The overweight cash relative to ILBs, and then overweight domestic equities to domestic property. And those are all, again, getting views from Herman and team, and us sitting down and seeing how these views and how these risks may or may not play out in a portfolio context. And for every portfolio, that decision is slightly different, because the risk objectives are different, the profile is different, and the expectation is slightly different. Mentioned as well, the outperformance from most of our domestic equity building blocks. So that tells me that we're selecting the right strategies and we're executing in the right manner. So we're able to move that, should I say, that needle, move the distribution in a positive manner. And at the same time, as I mentioned, on a shorter-term tactical perspective, the decision to include some currency overlays at some point during the last, say, 6 months has also added to performance. Of course, you can't get everything right, or not everything's going to go in your favor. And as you can see on the negative side, I've mentioned the subdued returns from growth asset classes. That's been the primary thing I guess the biggest thing that's keeping most investment managers awake at night. These are the things that we struggle with. How can we squeeze that lemon that I mentioned just a little bit harder? On the offshore side, we've got James here as well, and please, no jokes about the rugby. I think we've had a strategy session late last week, and he's pretty much had it for, I think, 2 or 3 days already, James. So I think that's enough for him. But jokes aside, from a global perspective, the team in London has done exceptionally well. And you'll see that even though they lag their benchmark slightly, what they have been able to do is in general, outperform the peer groups. So again, that's testament to the process, the philosophy. And keep in mind that what James and team does is exactly the same we do. They just do it on a different scale. From a fund return perspective, of course, what I want to talk about today is just the 2 multi-asset class ranges, focus fund of funds and the target fund of funds. And over the last year, just to maybe refresh your memory a bit, is how these funds have performed. Now, the bars in red, represent our strategic asset allocation. So if the bars are positive, it means that we're adding value. It means that we're better off in an actively managed solution than a passive implementation thereof at zero cost. It's basically an assumption. So I'm comfortable that we're adding value from whether it's stock selection, strategy selection, tactical positioning, all those little levers we've got to our disposal are adding to returns there. And then what I've shown in blue is the fund returns relative to the associated peer group that those funds actually reside in. So as you can see, again, whether it's Focus 5, 6, or 7, again, I'm pleased to stand here and show that we've managed to actually outperform there. But again, not necessarily thrilled about the absolute level of performance. On the more cautious portfolios, if I look at Focus 4 and 3, of course, those portfolios are constructed with very much a conservative, downside protection-minded construct. So as a result, those funds actually tend to have a slightly higher allocation to ILBs. Herman spoke about that earlier. And most likely a slightly lower allocation to offshore assets relative to some of the funds in the peer group. Turning my attention to the target fund of funds, and I'm not sure how familiar you are with this range. It's one that we launched, I think, roughly 2 years ago, and it's built on exactly the same principles. It's built on the same OBI investment principles, same strategic asset allocation. We've got exactly the same mindset. The only difference is the way we execute. Now, as you know, from a momentum investments perspective, we have a range of capabilities, whether it's in the fixed interest side or the fixed income side, or whether it's in the smart beta execution. Now, the target range is designed especially to harness those skills. So the equity execution, for example, is predominantly through enhanced index and smart beta strategies. I think you all know the smart beta phenomenon that has sort of like worked its way through the market. And we've been exceptionally successful in this. And I think also if you look at it from a TER perspective, from a cost perspective, this fund is intended to be more cost conscious. Therefore, from a pure TER perspective on a like-for-like basis, you would expect this fund to come in at a significant, I almost want to call it a discount, to some of the other funds. If you look at it from an outcome perspective, again, it's no use me just showing a 12-month number and feeling proud about it. But if I look at these funds and these strategies over a longer period, as you can see behind me, looking at relevant investment terms, again, credible outcomes. Both the focused funds are, again, compared to their peers, compared to CPI-linked objectives. And again, I think you'll agree that it paints a good story. From a probability perspective, again, it's similar to the previous, but I'm just putting it into numbers. So how often do we get to our CPI-linked objectives? Yes, we certainly have had an extremely challenging 3 years, or 5 years actually. But as you can see in the red bars, those probabilities of success are still fairly high. I think the one thing that's very important to note, of course, with these funds is that those CPI-linked objectives can't be guaranteed because these are market-linked portfolios. But we sure will try our hardest to get to those. Just quickly looking at it from a building block perspective, as I mentioned, so all the components that make up the respective fund of funds. First of all, looking at the focus fund of funds, what the chart behind me shows is that if the bars again are positive, the grey bars, they do look a little bit white on this side, a bit bleak. But if those bars are positive, it means that again those particular building blocks are again outperforming their peer groups or the peers. If those little dots are above the line, it also means that they're outperforming their market-linked benchmarks on a net of fee basis. So I think your attention will immediately be drawn to the right-hand side. And as I mentioned again, as you can see, it's been an extremely tough time for global asset managers as a whole. And I'm sure James will expand on that a little bit later. But again, looking at our implementation of the OBI philosophy in a global space, you can see those grey bars again sticking out. From a target fund of fund perspective, it's a similar profile. And what I'm especially proud of is this bar to the left, in terms of the execution through the smart betas and enhanced passive strategies within momentum investments. Again, for me, quite a big success story there. And then I just want to quickly ask, well, I'll tell you, I guess. I don't know if you know or are aware that if I look at the Momentum Equity Fund, this, for some of you, may still remember this as the Best Blend Specialist Equity Fund. I'm not sure how many of you know that this fund is actually ranked second in the general equity peer group over 10 years. So again, for me, I don't want to hop on it too long and too much, but again, this talks to the way we implement our strategy, especially on a building block level. So now we're talking about equities, different equity strategies, philosophies, styles, and so forth. So it talks to the consistency of the approach. And there you are. It's black on white. The numbers are right there. Just before I finish up, I guess, as I mentioned, the question that you sometimes get, and we certainly do, is, okay, we've had 5 years of depressed returns. Yes, we can eke out some outperformance here and there through the way we execute and so forth. But but what are we to do? We are falling behind on some of our objectives. We're not getting to CPI plus 5. I mean, I showed over 5 years, we're struggling to get to CPI plus 2. So what I just want to show, and again, this is something that I'm sure the team will probably distribute later on or on request. What we've just charted behind me is to show that for every single one of these profiles, call it focus 3 all the way through to 7, we said, well, if you extend your investment term on a predicted basis, and I'm just looking at betas, so I'm not adding any clever overlays, TAA, all those kind of things. How can we improve those probabilities? By just extending our investment term. Of course, I'm sure from your perspective, one of the answers may also be to save more. It just sounds so easy, doesn't it? But extending investment terms certainly, or investment holding periods, certainly helps. And if I effectively squeeze all those lines together, what you'll see is an incremental improvement in that probability. And I guess it's one of those stark realities that we are facing from a portfolio, both a portfolio management and a planning perspective. Just quickly on responsible investing, I just have one slide on it today, but I think I think in subsequent outcome matter sessions or wherever I think you'll interact with momentum investments, this is certainly something that you'll see come to the fore more and more. It's sometimes overlooked, but it's in reality given, and I think it's come to prominence even more and more so given certain failures or debacles we've had over the last year or two. But I do invite you to have a look at our website. It's momentuminv.co.za to see how we go about proxy voting. How do we vote on these AGMs that are often, sometimes it's contentious, sometimes not, but we do take an active role. As Momentum Investments, it's important for us to take an active fiduciary role and responsibility in terms of how companies are run. I think South Africa has been blessed, or it's been well known to be very high up from call it a regulatory corporate governance perspective. And we need to either build on that reputation or correct for some of the wrongs. And that's where we play an active role. I think maybe in summary, just to manage time as well, as you can see behind me, just a couple of things that are maybe some takeaway points. I talked about the peer relevant returns. Don't forget that. Yes, we will go through times where we will go through shorter time periods when returns probably won't be that great. It's part of the process. It's part of the journey. And remember that we're managing that over time. And you'll see those results come through. Spoke about the expectant or the optimism around, call it some of the growth asset classes returning to, I don't want to say former glory, but at least to pick up in terms of their delivery. And lastly, I guess, if I talk about enhancements, it's part and parcel of what we do. It's an ongoing process, but what you will see in coming weeks and months is you will see some changes coming through in the portfolios. Whether it's introduction of another investment strategy, whether it's, we're making some changes on the global side as well, in terms of both the portfolio execution and the management of costs. I mean, that's the one thing we can do. That's within our should I say, ability. Because in periods, as we are in now, and potentially over the short term of lower yields, lower returns, is the management of costs. So if we can get that right, that's something that immediately drops down into a portfolio return. So that's my slide deck, I guess, in a nutshell. I do thank you again for your time and your willingness to be here and your support, more importantly. And on that note, let me just say, I wish everyone a great festive season and looking forward to see you in the new year. Thank you. Questions? Look, I think it's interesting that you often see this dynamic about passive versus active come to prominence, I guess, from time to time. And you often see it when passive funds have actually had a good run. I think certainly the way we approach it, and I think you do see that within, whether it's in the target fund of funds, the enhanced or the focus fund of funds, is that we do employ a strategy of, because we're a solutions business, we look at all the levers at our disposal. So typically, we will have exposure to, number one, active funds, enhanced passive funds, smart betas. We look at the full range. So where there are potentially certain asset classes where you do want to be passive, and then we'll do that. I mean, that's basically looking at the way we execute it on offshore property, for example. So offshore property, we included in the target fund of funds, I think this time last year, and we managed to get it into the portfolios I think about 6 months ago. They will go passive. They will execute through a passive mandate because it's a difficult benchmark, it's a difficult asset class to outperform, and we can get it at a decent cost. So 100% correct. We will execute passively where and when it makes sense, but don't lose sight of the power of a multi-asset class fund. I guess that's where you and your clients should gain a lot of comfort. That, simplistically put, that sometimes you'll avoid the losers, sometimes you'll have exposure to them, but overall, that's the diversification benefit that you get from a multi-asset class fund. We often talk about almost this white knuckle ride, and that is the one risk that you do have with just single asset class exposures. That these asset classes, as we know, they have their own profiles, their own, should I say, drivers of return, but it's through a multi-asset class fund where you can really manage for that risk. So it's Herman calls it the one free lunch, diversification, and that's certainly what a multi-asset class fund is. Where's the sleep at night factor? I think that's exactly where the sleep at night factor is. I think for me, thank you for the compliment first and foremost. I'd love to know. Anonymous, please come see me afterwards. But that's certainly it. I think our history shows that we're good at what we're doing. We're good at combining asset classes in a manner that is well managed, controlled, and the way we execute adds to that. So for me, that's exactly it. And remember that every single one of these funds are constructed with a certain objective. It's great for me to look good against peer groups, whether you slice and dice the returns. I mean, you can also, you always have a start-end bias to returns. But the reality is that it's great to look good against peers, and it feels even better knowing that we're managing towards a certain objective. So that's where I think you should have comfort that, the team, with its experience, has been doing exactly the same thing for, 10, 15 odd years, and we'll continue to do that. It's part of our DNA, I guess. Okay, well, the Focus 6 fund of fund has actually outperformed the benchmark over a one-year basis. That's looking at the clean class. So I think it's the C class, which has outperformed our SAA. It has underperformed the CPI-linked objective, if that's, again, anonymous. So yes, there's underperformance relative to CPI objective over 1 year. And I think, based on the slides, I think there's enough evidence to show why that is the case. I would love to meet the manager that has actually achieved CPI plus 5 over the last year with a multi-asset class solution, James. Oh, and in local currency. So from that perspective, it's been an incredibly tough year. It's been an incredibly tough year from a CPI-linked objective. Remember, we're solving for a longer term year as well. So, it's not CPI plus 6 per year, every year for 6 years. We have to look at this over a period of time, because as I mentioned, returns don't come in a straight line. If it was that easy, then, as I said, I probably wouldn't have been here. Would have been on a yacht in Bermuda. Is there anything else, Renee? That's it. Thanks again for your time. Appreciate it. And have a good day further.